Investors are horrible at, well, investing. Every year, investors watch their money go down the toilet because of bad decisions and bad stocks. In this video, I'll show you the 3 biggest mistakes investors make and 3 rules to keep you from losing money in the stock market. Then I'm going to reveal a simple investing strategy that is so easy you're not going to believe it at first. We're talking protecting your portfolio today on Let's Talk Money. Beat debt, make money, make your money work for you, creating the financial future you deserve. Let's Talk Money. Hey Bowtie Nation, Joseph Hogue with the Let's Talk Money channel here on YouTube. A special shout out to everyone in the nation. Thank you for spending a part of your day here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Probably one of the most frequent questions I get here on the channel is how do I make money in stocks? And most people are shocked by my answer. Making money in stocks is easy. The stocks in the S&P 500 have produced a 15% annual return over the last decade, 15% a year since the pit of 2009. Now that's without doing any stock picking, without finding those best of breed names that we talk about on the channel, just investing across that broader market. Now the real question everyone should be asking is how do I not lose my money in stocks once I've made it? Think about it. Investing just $100 a month at a 15% annual return means having over $500,000 in 30 years. That's trading 1 cup of coffee a day for $521,000 and simply putting that money in stocks. But that's not what happens, is it? The average investor makes between 2 to 4% a year according to an annual survey by Dalbar Research because they make all the worst investing decisions. They commit the 3 cardinal investing sins that we'll talk about in this video and they lose money. In this video, I'm going to show you why investors lose money in stocks and 3 rules for keeping your hard-earned dough. We've all been fortunate enough to live through that longest bull market in history. Now I want to show you how to protect your money, keep growing your portfolio, and keep from falling into one of these biggest investor traps. Besides these 3 rules for not losing money in stocks, I'm going to show you a bonus investing strategy that's going to tie everything together towards the end of the video. Make sure you watch out for that because this is the strategy I use as well as most of the analysts on Wall Street. And our first rule here is just to limit the amount you have in any single stock to 5% or less. Investors love to get emotional about shares of a company. Just ask any investor what they think of Tesla or Apple or their favorite dividend stock, and God help you if you say something bad about it. Now the problem with this is they have a tendency to go all in on those stocks. How many times have you heard someone say, I've got all my money in tech stocks, or I just put 30 grand in Tesla ahead of its earnings report? You might not even realize it until it's too late. You buy into that company and get really excited about the shares, but the share price just starts dropping. No worries, you buy in another chunk to dollar cost average your investment lower. Now the shares have only got to rebound a little bit to make your money back and maybe even a little bit profit. What happens though is that before you know it, you've got 20 or 30% or more of your money in this stock. I have a friend that followed coal miner Peabody Energy all the way down in 2016, eventually having 30% of his portfolio in the stock and losing $30,000 when the company filed bankruptcy. Limiting the amount of money that you're going to invest in a single stock means avoiding these apocalyptic losses where you wipe out years of gains. So the rule I use is that 5%, no more than 5% of my wealth in any single stock. This means I might start with an investment of maybe 2%. So if I have $100,000 in stocks, I might invest 2 grand in the stock. Now that's going to leave room, that remaining 3%, to buy more of the stock if I do want a dollar cost average lower later. But I stick with that rule. If I keep buying and hit that 5% limit on the stock, it doesn't matter how much I love the company. I do not buy a single share more. Now I know it seems like this is going to limit your gains in those winning stocks, but please believe me, this rule is going to save your ass. Ignore it and eventually you're going to chase that losing stock all the way down and lose tens of thousands of dollars, just wiping out a big chunk of your portfolio. Now another rule to avoid losing money in stocks is to always evaluate a stock on its future potential, not what has happened in the past. Now this is another tough one because we get a line of reasoning in our heads and it's very difficult to dislodge that even when new information comes along. For example, you invest in Netflix on its unrivaled dominance in streaming, no other major competitors, huge potential market, and just excellent growth ahead of it. Then competitors start entering the market. In Disney Plus, HBO Max, Apple, Netflix starts losing subscribers, but you still stick to that idea that the company is a best of breed in streaming. You avoid looking at all this new information in the market because it conflicts with that initial investment theory. Now there are a lot of deep psychological things going on here that you have no control over. We're hardwired to avoid losses and stick to those first impressions that we have. Now, a big mistake investors make here is seated in what's called loss aversion. And this is a subconscious avoidance of even acknowledging losses or mistakes. Have you ever been down so much in a stock that you just didn't want to look at your portfolio? Have you ever held on to a stock despite losing 20 or 30% because you just didn't want to take that loss? You cannot get hung up on how much you paid for a stock or how much you've lost in it. If you thought shares of that $10 stock were going to $15, but then new information came out that affect your reasoning, you have to look at those shares again and honestly decide if you still want it in your portfolio. I know it sucks to take that loss on the investment, but you've got to constantly be reevaluating your stocks with all the current information, both the good and the bad. If the shares are no longer a good investment, if that upside potential no longer meets your return requirements, then you need to look for a better investment. Now, this doesn't mean you have to sit in front of CNBC or your favorite investing platform 24 hours a day. Barring any shocking headlines, you can reevaluate your stocks once every 3 months after the earnings are reported. Now, in that strategy that I'm going to share later, I'll show you how to make this all easier and less time consuming, going back to analyze all your stock picks. The point here is, it's not how much you paid for a stock. It's not the price target that analysts had on the shares when you bought it. Whether you've lost money or not, none of this has anything to do with keeping that investment. The only thing that matters right now is that impartial assessment of the future stock price and whether that growth is enough to hold on to the investment or to go buy something else. Now, our third rule before we get to that bonus investing strategy is always have a defined point when you're going to sell a stock. And this one ties into that last rule to help you avoid holding those losing stocks as they just burn your portfolio to the ground. And selling those losers is one of the hardest things to do, and part of it is because of those shifting expectations. For example, maybe you buy a stock at $100 and expect it to go to $150 a share. Then the shares fall to $80 each, and now maybe you're only thinking that fair value is $105 a share. That's not much above what you bought it for, but it's still a 30% increase from that new lower price. And it's not just those expectations on stock prices that can shift. You might have invested in a company because of its reputation for excellent customer service. Then a scandal is uncovered where sales reps were abusing client accounts and management let it happen. If that sounds familiar, it's exactly what happened to Wells Fargo investors over the last few years. The company was the poster child for customer service until it was discovered that client accounts were being used to open new accounts, charging millions of dollars in fees and just abusing that trust. The stock has been dead money ever since. So when you go to buy a stock, bullet point out the reasons down to your target price and competitive advantages the company has over its peers. Then bullet out a set of reasons that you might sell those shares. This is going to help you avoid that idea of shifting expectations for that stock. If one of your rules is that you sell a stock that's lost 15%, then that takes all the risk out of that decision. It reduces the possibility to zero that you'll follow any stock down to bankruptcy. Now, if you write out one of your reasons for investing is because of big potential in a new project, and that company ends up scrapping the project, then that avoids you looking for an excuse for holding those shares any longer. You've formalized your reasons for buying the shares and what would make you change your mind. Now, it just takes all the guesswork out of investing and keeps you from making some of those biggest money-losing mistakes. Now, I want to share that bonus investing strategy with you, a strategy that's going to make investing as stress-free as possible, and the one that I use. This is called the core satellite strategy, and it's where you put 60 to 75% of your money into broad funds or ETFs. We're talking about funds that cover the asset classes like stocks, bonds, and real estate. Maybe you invest in a fund for dividend stocks or one of international companies, but just getting that real overall market appeal. Now, these funds are going to give you those market returns, diversify your portfolio for that smoother ride. Then you take the rest of your portfolio, that 25% or so of your money, and invest that in a small handful of individual stocks, maybe 7 to 12 stocks. By limiting your portfolio to less than a dozen stocks, you solve a lot of these problems that lose investors money. You're not consistently looking for those new stock picks. That's going to save you hours, plus it means you'll only be investing in the very best stocks that you find. It makes it much more practical to keep up with your stocks, keeping up with the research and where that company is going. Now, that's something you can't do if you're investing in 20 or 30 stocks, but it comes much more manageable with 12 stocks or less. Use these 3 investing rules along with that core satellite strategy, and you will avoid making the worst of those investor mistakes that lose money. You'll get those market returns plus the instant diversification from that core part of your portfolio. You'll get that potential upside for a few extra percentage return on that handful of individual stocks, and you'll know when to sell to avoid losing money. Check out the video to the right for the 5 Vanguard funds I use for that core satellite strategy. And these are 5 funds you can buy for that simple, stress-free portfolio of stocks, bonds, and real estate. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.